There is a financial game you have probably been playing your entire life. But here's the strange part. The rules change as you get richer. When you have $500, money behaves one way. When you have $10,000, it behaves differently. At $100,000, something changes again. And once you have millions, you aren't just playing the same game with more money. You're playing with more options. You can access opportunities other people can't. You can wait when other people are forced to act. You can take risks that would be impossible for someone with no financial cushion. And sometimes, you can even make money without selling the thing that made you wealthy in the first place. Sounds unfair? Maybe. But here's the interesting question. How exactly does this happen? And more importantly, can an ordinary person start building some of these advantages long before becoming rich? Let's find out. Imagine you have $500 in your bank account. Your car suddenly needs a $400 repair. You don't really have a choice. You have to find the money. Maybe you use a credit card. Maybe you borrow from someone. Maybe you delay another bill. Your $500 wasn't really working for you. It was protecting you from disaster. That's what happens when you have very little capital. Your money has a job, survive. Now imagine you slowly build your savings to $10,000. The same $400 repair happens. It still hurts, but it doesn't control your entire month. And that's the first level of financial power. Your money starts giving you breathing room. Now imagine you've built $10,000 in savings. Then the stock market suddenly drops. You open your investment account, and everything is falling. Your first instinct is panic. You want to sell. But then you remember, you have cash. Your bills are covered. You don't need the investment money tomorrow, so you don't have to make a decision based on fear. You can wait. And waiting is an advantage. Because financial markets don't care whether you're scared. But your financial situation determines whether you can stay invested when things get uncomfortable. That's why one of the first advantages of wealth isn't higher returns. It's the ability to avoid desperate decisions. Eventually, you begin investing. At first, the numbers look almost pointless. You invest $100, then $200, then $500. Months pass. Your investment account grows. But slowly, you start wondering, why am I doing all this? Then something changes. Your investments become large enough that the market movement itself starts becoming noticeable. A 5% increase on $1,000 is $50. A 5% increase on $100,000 is $5,000. A 5% increase on $1 million is $50,000. The percentage didn't change. Your capital did. And this is where wealth starts becoming self-reinforcing. The more productive assets you own, the more significant their growth can become in dollar terms. Here's a question. What would happen if you stopped working for a month? For most people, their income would drop dramatically. But what if you owned part of a business, or a diversified portfolio of investments, or other productive assets? Those assets could potentially continue generating income or changing in value even while you're asleep. This is the fundamental difference between earning money and owning assets. Employees are usually paid for their work. Owners can benefit from the performance of what they own. And wealthy people tend to accumulate ownership. That's why a millionaire's financial statement can look completely different from a typical worker's. Their biggest asset may not be the cash in their checking account. It may be the things they own. Here's where the game gets interesting. Imagine you find an investment opportunity that could potentially return 10%. You invest $1,000. If everything goes according to plan, you make $100. Not bad. Now imagine someone has $1 million available for the same investment. A 10% return would be $100,000. Same investment, same percentage, same year. But the outcome is radically different. This is why wealthy people don't always need to find extraordinary investments. They can potentially make meaningful dollar gains from ordinary percentages. Scale changes everything. And this is one reason the first stage of wealth can feel so slow. You're trying to build the machine. Later, the machine becomes powerful enough to help build itself. Now imagine you walk into a bank. You need a loan. The bank wants to know, how much do you earn? How much do you owe? What assets do you have? What's your credit history? How risky are you? Now imagine you have strong income, excellent credit, and substantial assets. Your financial profile looks very different. You may have access to financing options that someone with weaker finances doesn't have. This doesn't mean the bank gives you free money. It doesn't. But it can mean you have more choices. And that's becoming a recurring theme. Wealth creates options. Options create flexibility. And flexibility can create opportunities. Here's one of the most interesting parts. Imagine you own a valuable investment. You've held it for years. It has grown significantly. Now you need cash. One option is obvious: sell it. But selling an appreciated asset can potentially create a taxable gain. So wealthy investors may consider other options depending on their circumstances. They might use cash reserves. They might sell another asset. They might use financing. The important point isn't that borrowing is always smart. It isn't. The point is that having assets can create multiple ways to solve the same problem. And when you have multiple solutions, you have leverage over your own financial decisions. Now imagine you have enough financial security that you don't have to accept every opportunity. Someone offers you a job. You don't like it. You can say no. Someone offers to buy your investment at a price you don't like. You can say no. A business opportunity looks risky. You can walk away. An emergency happens. You don't have to immediately liquidate everything. That is something people often misunderstand about wealth. The luxury isn't necessarily the sports car. The luxury is choice. Being able to say no, and not having your entire financial life collapse. But there's an important warning. You shouldn't look at wealthy people and copy every financial move they make. Why? Because their financial decisions are often built on a foundation you may not have yet. A wealthy investor might take a certain amount of risk because losing that amount wouldn't destroy their financial future. Someone with $5,000 in savings taking the same risk could be catastrophic. This is why copying an investment without understanding the underlying financial position can be dangerous. The goal isn't to copy rich people's lifestyle. It's to understand the principles that created financial resilience. Build savings. Control expensive debt. Invest for the long term. Own productive assets. Protect yourself from catastrophic losses. And gradually increase your financial options. So, what is the secret financial advantage rich people have? It's not that they have a secret stock market. It's not that banks magically give them free money. It's not that every rich person knows some mysterious tax trick. The deeper advantage is much simpler. They have enough capital that money itself becomes a tool. When you're starting out, you work for money. Then you save money. Then you invest money. Eventually, your investments can start working alongside you. And if you keep building, your capital can become large enough to create opportunities that were previously unavailable. That's the transition. From I need money to I have money. And eventually, my money gives me options. That's the real financial advantage. Because wealth isn't ultimately about how many things you can buy. It's about how many things you can choose. Choose when to work. Choose when to wait. Choose when to invest. Choose when to walk away. Choose when to take a calculated risk. And choose how much of your time you want to trade for money. So if you're still building your first $10,000, don't underestimate it. That money isn't just sitting there. You're building your first layer of financial freedom. Then comes $50,000. Then $100,000. Then whatever number comes next. The numbers matter. But the real goal is what those numbers give you. More time, more flexibility, more resilience, more choices. And eventually, the greatest financial advantage of all, the freedom to say no.